Just a few years ago, the BRRRR strategy was like magic. Buy and fix up a property, refinance, pull out all of your money, and then repeat. But today with higher interest rates, that formula doesn't work the same. So is the BRRRR strategy dead, or are there smarter ways to adjust and still make it work in today's market? That's what I'm going to show you in this episode. Hey, if we haven't met yet, my name is Chad Carson. You can also call me Coach Carson. And on this channel, I teach you how to use real estate investing to achieve financial freedom so you can spend your time doing more of what matters. So I'm going to jump into an example with real numbers, but before I show you what things look like today, I want to go back to the good old days, back when interest rates were 4.5%, and show you what a real deal would have looked like, at least for me in my market. So let's say I was buying a single family house, 3-bedroom, 2-bath, be a typical kind of B+ neighborhood rental for me. And a good deal for me would be buying it at about $175,000. And maybe I had to put rehab into it, remodel it, fix it up, put, let's say, $50,000 in remodel costs plus other holding and closing costs. But the main point is my total cost in this deal would be $225,000 all in. And the ARV, or the after repair value, would have been about $300,000. So it's about 75% of the total value is what my cost in the property is. Now, the question is, how would I have bought this property? How would I get the money to buy it? So even if I didn't have my own money, what I might have done is used a home equity line of credit, like a line of credit from another property. Maybe I would have used a private money lender. That's how I grew a lot of my business. Or eventually I had my own cash as well, but maybe I didn't want to leave all my cash in the deal, but I used it short term to buy the property, fix it up. But somehow, some way, I have to have $225,000 in cash to buy it and do all that. But then the point of the BRRRR strategy is then maybe I get it rented, I get it stabilized 3 months later, 6 months later, maybe a little bit longer. I refinance it and I use a long-term fixed mortgage. And so you use like a 30-year fixed mortgage, like a conventional loan, or maybe what's called a DSCR loan, debt service coverage ratio. Both of those are really good options for investors. And I do a lot of videos and other content on that. But let's just say in this example, because interest rates were really low, I could get a 4.5% 30-year loan, and I borrow 100% of my cost in the property. And the reason I'm able to do that, and here's the whole key of the BRRRR strategy back then, was you had to have all your costs be below about 75% of the full value. In some cases, maybe that's 70%. It depends on the loan program, but you're almost always trying, this is the limitation, is making sure your costs are below that. And if you have all your costs below that, you could pull out 100% of your money. If you had 80% in the deal or 85%, maybe you'd have to leave some in. But the point was the amount of the loan to value is kind of your limitation. And you would get a loan payment of about $1,140 per month on a 4.5% loan. And the way that looked on a rental property like this, in my area, a $300,000 property would rent for about $2,000 per month. And I'd have $800 in operating costs. So this is all my expenses except for my mortgage. So things like taxes, insurance, management, maintenance, capital expenses, things like that. And so what's left over is called my NOI, my net operating income. And I use the NOI to pay my mortgage payment. And I want to make sure that's more than my mortgage payment. The more, the better, because that means I have positive cash flow. But in this case, even on a good deal and a good location like this, getting a $60 per month, $100 per month cash flow would have been a good deal for me because I'm locking that in. I have a 30-year fixed mortgage and things are only going to get better in the future as the rents go up, as I pay my principal down, as the price of the property goes up. You know, this is a deal where I have 100% of my money refinanced. So I have none of my own money in the deal, and yet I'm making a profit. And let's take a look at what some of those profits might look like. Just as a rough example, the returns I'm getting on this deal, getting a little bit of cash flow, 60 a month, 720 a year. That's not the main thing that I'm excited about up front. I'm also paying my loan down, in this case, about $3,630 per year. And then the appreciation when you're using leverage like this is really the majority or most of the profit you're going to make on the wealth you're going to build on this property. And so not only the fact that we bought it below value, $75,000 below the full value, but the full value is appreciating. If it's at 3%, that's like $9,000 a year. If it's at 5%, that might be $15,000 a year. You know, no guarantees. The timing on that is never going to be like exactly how you want it. But if you hold the property for 10 or 15 years in a good location, you're going to benefit from these waves of appreciation. And the point is, you have none of your own money, yet you're making over 13, maybe even more, 14, 15,000 bucks a year with none of your own money invested. So you could stack that up. You could do 1 and 2 and 3 and 4. By the time you have 5 or 10 of these properties, you're making a lot of growth and you've recycled your cash over and over and over again. That was the formula for how to grow. But what happens when interest rates change and you can't do it exactly like that? I want to show you the numbers, what that might look like now. So in this example, I'm going to keep the numbers exactly the same, the type of property exactly the same. So again, I buy a single family house, but this time it's in 2025 when I'm recording this, and I pay the same price, 175, the same remodel cost. I have the exact same total cost in the property, 225,000, and the property is still worth 300,000. So far exactly the same. And I use the same type of financing to buy it. I use my cash, the home equity line of credit, private money lender. All of that's pretty good. And most lenders would look at that and say, yeah, you're at 70, 75%. I'm willing to loan you most of that. And you can still do the deal. So far, so good. But the problem comes in when you go to do the refinance of the BRRRR strategy. This is when things have changed. And the reason why is because the interest rate might be 7% instead of 4.5%. And so what does that mean? That means the payment, if you borrowed the same amount, and I'm going to assume we borrowed, let's say we borrowed 225,000, which is the amount of money we borrowed before. And you remember that it was 75% of the full value. So a lot of banks looked at it and said, well, 75% is, below the full value. We're willing to loan that to you. But if they did loan that to you, your payment at 7%, if you put it in an amortization calculator, would be about $1,497 per month. And so even if a lender would let you do that, you're going to have a lot of negative cash flow, because remember, this property, if it rents for $2,000, it only has an NOI of $1,200 per month. So you have about negative $300 per month in cash flow. Even though you bought it below the full value, you're losing $3,600 per year in cash flow. And that's kind of a painful thing to do. Maybe if you have a lot of cash right now, maybe you say, I could do that for a little bit, but you might do that on 1 or 2 deals, and you're going to get kind of tired of having negative cash flows. It's called an alligator. It's not a smart way to start your property. So really the only safe way to do that, and what I would recommend, is that you need to put more money down. You need to borrow less money. And so instead of borrowing 225, we need to figure out how can we have about the same monthly payment as we did before? Remember, it was like $1,140. So you can put that in an amortization calculator and kind of work it backwards and say, if I kept my payment at $1,140, what's the most money I could borrow for 30 years at 7% interest? And that equals $171,500 plus or minus, pretty close to that. So in order to do that, you would have the same amount of cash and HELOC or whatever in the deal, 225, but then you're going to refinance and only pull out 171,500 on your refinance. So you're going to have some money left in the deal. In this case, about 53,500. Now the question, 2 questions. Number one, do you have that amount of money you can leave in the deal? Let's assume you do for now. Now I'm going to talk about ways to do this kind of deal if you run out of cash, if you don't have the money and you want to keep growing. But let's assume you have the 53,500. Question is this a good deal to leave your money in there when you used to be able to pull it all out? So I want to actually use a spreadsheet called an internal rate of return spreadsheet to show you whether I think that's a good deal or not. Now, if you're not familiar with an internal rate of return, this is a formula that I use on almost every single deal I do to try to understand if this is a good deal or not for me. And if you're not familiar with it, I've done some videos on the past. You can look for a link in the podcast or YouTube description to watch that. And if you want to follow along with this spreadsheet and look under the hood at the exact numbers I'm doing, you can also get a free copy of this spreadsheet. Look for the link in the YouTube and the podcast description below. But let me unpack this real quick to show you how I might evaluate this. All those numbers we had on the whiteboard, $175,000 price, the $50,000 in other costs, those are all the same in here. So I plugged those in. And remember, I have about a 75% cost to value. This property is worth $300,000. My total cost is $225,000. But the question here is the financing and my down payment. Because remember, I'm going to borrow $171,500 on the refinance. So I'm going to leave $53,000. I'm calling that my down payment into the property. And the question is, and this is what internal rate of return helps us answer, is this a good deal? And I'm going to assume that I hold this property for the next 10 years. I collect the cash flow that I have on the property. And I'm going to also assume that, it's $720 today. I'm going to assume that cash flow grows by about 3%, about the rate of inflation or the rate of growth of the overall market. I'm also going to assume that the price of the property at $300,000 today grows about 3%. And I'm going to show you what happens. We can kind of stress test this to show you what happens if it goes a little bit faster, what happens if it's at 3%. But in this example, we put $53,500 in year one, in the very beginning, and then we collect cash flow for 10 years. The loan pays down a little bit every year. The price of the property, the value goes up over those 10 years. And at the end of 10 years, we sell the property. We have to pay some realtor commissions. We have to pay some closing costs, about 7% total. And then what's left over, we're going to use that sale to pay off the debt that we owe at that time. And that's going to be our chunk of money at the end. So that's how we make money. We put 53,500 in, we collect a little bit of cash flow over time, and then we have a big chunk in 10 years. And the question is, what's that rate of return? And internal rate of return takes all of those cash flows and it gives you a rate of return over that entire period of time. And in this case, if I used all those examples, I would make about a 16.4% return on my 53,500 if it grew at 3%. Now, what happens if this is a really nice area, a really good area, when you've picked it carefully and it grows even better? I'm going to change the appreciation rate and the cash flow growth rate to about 5% instead. And again, this is all speculation. You don't know exactly what it's going to be, so you might want to test both of these. But if it grew at 5%, I had a really good tailwind, I'm going to be about a 20% return. So the question you always have to ask as an investor, at least I ask myself, is I'm taking some risk here. I'm borrowing money, but I think I'm doing it pretty safely. I'm below the full value. I'm not making a lot of cash flow up front, so there's some risk to that. I could put it somewhere else and make a little bit more cash flow perhaps. But is a 16% or is a 20% anticipated return, my expected return, is that good enough? And that's a personal question we all have to answer. But I'm going to put forward for myself, at least, that making a 16 to 20% return is pretty good. Like that is worth me leaving my money into the property. So the question number one that we talked about earlier is doing a deal today when you have to leave some money in the property? Well, it depends on the numbers of the deal, right? But if you run the numbers like we did here, and you can say, here's what I think I'm going to make, this is the range of what I think the return on my deal is going to be for the next 10 years, you can make that choice for yourself. You can make a clear-eyed decision. But the second question might be, is like, well, Chad, what about growing? I'm going to use my 53,000 and then I'm stuck. Like I can't do anything for the next year or 2, 3 while I save up another down payment. And so I want to talk about that a little bit because I've been in that situation. I grew from zero and didn't have a lot of cash after I put it in one deal and I'm done. I had everything there, and yet I was able to still keep doing deals. So I want to give you a few ideas in today's market with higher interest rates, how you could continue growing safely, even if you use up all your cash on the first deal. So I've got 4 different ideas for you. Let's call this the new BRRRR strategy. The BRRRR strategy, when interest rates are higher and you're having to adjust your strategy. And idea number 1 is that you can just delay the whole refinance process, call it a delayed BRRRR. So maybe you can't do it in 6 months, but maybe you wait a year or 2 or 3 and the rents go up and you have a little bit more cash flow and you're able to then be able to afford to refinance it. Maybe the interest rates actually drop and you're going to be opportunistic. Like none of us really know what interest rates are going to do. We can always speculate, but we can also be prepared for that. So maybe you have a couple of deals lined up where like if interest rates drop down to 5%, you would take advantage and you would just jump on it right now, refinance it, pull your cash out so you could then grow a little bit more once the interest rates went down. So a delayed BRRRR is a strategy of just being patient and being strategic about the timing of when you're going to do that. So that's option number 1. Option number 2 is that instead of refinancing the entire deal, you could work on what's called an investor line of credit. It's actually not a home equity line of credit, just looking for an investment property line of credit. And these are not as frequent or as common as getting a home equity line of credit on your personal residence, but they are out there. And if you talk to people like the mortgage broker, I recommend a lot of investors to Brian Maddox. I'll put a link for him in the video or the podcast description. You could talk to him about what programs are out there. And I've seen lots of investors do it. There are programs where maybe you can get a 75% home equity line of credit, or line of credit on your rental property, meaning the difference between what you owe on your first mortgage and 75%, you can get basically you can draw at any time. So if you have 2 or 3 properties like that, maybe you can then draw on that money to maybe buy the next BRRRR strategy deal. And maybe you can use that as your cash. I talked about earlier, that early money to buy it and fix it up. You could use that and to do deals and then refinance it, pay it off, or sell it and pay it off. And so that could be one option, is just to use a line of credit. A third one, and probably my favorite, if you're going to buy long run and just hold these properties long run, is to mix in a silent partner with you. And the whole concept here is most people with the BRRRR strategy are used to doing 100% of the deals by themselves. And I like that. Like I would rather do it without a partner if I can. But what if you don't have any money? Like what if you've used $53,000 on your first deal? So let's call that deal number 1. You did that solo. You used your $53,000. Awesome. That's your deal 100%. But now you're sitting on the sidelines saying, well, I'm just going to wait 2 years or 3 years until I can save up $53,000. But what if there's a deal 3 months from now? Would you rather just pass on that deal, or would you rather do the deal and give part of that deal to somebody else, but you get the other half? Like, I would much rather have half of a deal than 100% of no deal, right? And so you can learn to use silent partners. And there's a lot of different structures here. I've done videos on my channel on this. If you want me to do more of those, leave a comment, let me know, and I'll kind of revisit that topic. But there are multiple ways you could structure a deal where somebody is the passive partner. They put up 100% of the money. You bring the deal, you manage it, and you can do essentially a joint venture together and hold the property together. And you can benefit. You can both have a win-win as long as it's a good enough deal. You could do your first deal solo, your second, third, fourth deal with a partner. Then once you save up enough cash or maybe you build enough wealth, you can start doing all the deals yourself again. But I've done this myself. I've seen other people do it. My mentor, John Schaub, did this a lot. Having silent partners is a way to continue growing and have just part of a deal instead of 100% of every single deal. The fourth idea, and this is just kind of being a little bit sarcastic, is just grow slower. I think so much of the emphasis on the BRRRR strategy was, wow, I can grow fast. I can buy 2, 3, 4 deals in a year and I can grow. That's great. Like, I have done that too, but I also made a lot of mistakes by growing fast. And sometimes I think, especially in the first 2, 3 years, just going at a more reasonable pace, 1 property per year, maybe 2 properties per year, just taking your time, you learn a lot. You get better with every single deal. And that's okay. You don't have to light the world on fire and be the fastest investor. Like, there are no awards for being the fastest investor to 10 or 20 properties. The award is your personal reward for actually getting to the finish line of financial freedom. And so taking your time, being kind of more of a tortoise is actually, a little bit less stressful in many cases. And yes, maybe you do fewer deals, but remember, you could use silent partners and do it a little bit safer. Having a silent partner has a little bit more money behind you. But the point is, you can still get there. You can get there at a reasonable pace. It just save money the old-fashioned way until you get enough money to do another deal, and you can still accomplish all your goals. And I think that's a great way to go as well. So is the BRRRR strategy dead? I don't think it's dead. I think the old mindset about how to use the BRRRR strategy was broken, and we had to fix that. But let me know in the comments if you think the BRRRR strategy is dead, if you're using it differently, how you're using it. I think the most important thing, the way to adjust to the market we're in right now, is getting really good at being able to run the numbers. And I focused on one particular formula called the internal rate of return in this video. It's something I use a lot. And so if you're not familiar with that, or if you just want a refresher on that, my next episode or my next video is all about how to use the internal rate of return and that spreadsheet that I showed you. So if you want to get better at that, watch that video. There'll be a thumbnail above me here you can click on if you're watching on YouTube, or if you're listening on the podcast or watching on YouTube, there'll also be a link in the YouTube and the podcast description below. So check that out. Thank you so much for watching this video or listening. I'll see you in the next episode.